Oh, they're definitely going in December. It's not 60%, it's 90%. I think the bigger risk is what if you get a 300,000 number in a month's time? Because you've got to start thinking about what is the path after December. But today's number it's a no-brainer. They are moving in December.
I think the question is now not so much about the December rate hike, that does seem very likely, but really what's the path beyond that? And what's the signal going to be from the Federal Reserve at the December meeting? What happens to the dot plot? It looked in the last dot plot as if the Fed leadership had slowed the pace of hikes to 75 basis points in 2016. There's a question of whether that might go back up to something higher. I mean, I still think it's going to be gradual by historical standards, but the issue...
Is it too soon to talk about March for a second hike?
That would be my expectation. I mean, of course, it's too soon to be confident on that, but I don't think it's too soon to talk about it.
We're still very bullish on stocks, so I'm going to give equities a 5.
5 out of 5.
5 out of 5. Sorry, 5 out of 5, not 5 out of 10.
Whoa, listen to that. Nice.
All right, now you're going to have to justify your case given the fact that we've got a strong jobs report. Looks like the Federal Reserve is going to tighten in December, and a lot of the good news has already been priced in over the last few weeks. Why are you so bullish?
Yeah, that's right. There's a lot of good news baked in, but we have to remember the Fed tightening is really adjusting rates because the U.S. economy is hitting escape velocity. So that's very bullish. The second thing to keep in mind, and we published this a week and a half ago, and I know it's going to sound weird, Fed tightenings are usually accompanied by weaker dollar, and weaker dollar means positive earnings revisions. So I think you're going to start to see positive revisions to earnings next year, especially in the early cyclical space, including energy. And the third is I think you're about to see a gigantic reallocation of capital in 2016 towards stocks.
You don't want to extrapolate a trend from one print. It does suggest, though, that the labor market's kind of bouncing around a trend of, say, 200 or so on a monthly basis on average. That's been the last 3 months. I think what it does, though, is it adds confidence to the story in 2016, particularly around the job data and, importantly, the wage data. Wage growth up 2% and change, about 2.5%. So the consumer story really for 2016 maybe be setting up a little bit stronger. It does really argue for the Fed coming into play in December and setting the pace for modest increases through 2016.